The Red Flags Rule was promulgated in 2007. It was enacted into law as part of the Fair and Accurate Credit Transaction Act of 2003. The purpose of FACTA was to update and amend the Fair Credit Reporting Act. To better define the term update and amend, the official purpose was to amend the Fair Credit Reporting Act to prevent identity theft, improve resolution of consumer disputes, improve the accuracy of consumer records, make improvements in the use of and consumer access to credit information, and for other purposes. As people who deal with consumer credit reports, this act had quite an effect on mortgage brokers. Implementation of FACTA created disclosures and other provisions of credit information management that drastically changed how MLOs and brokers communicate with consumers. The Red Flags Rule is enforced by the Federal Trade Commission, the Federal Bank Regulatory Agencies, and the National Credit Union Administration. If you work for a bank, federally chartered credit union, or savings and loan, check with your federal regulatory agency for guidance. The Red Flags Rule applies to financial institutions and creditors. The rule requires you to conduct a periodic risk assessment to determine if you have covered accounts. You need to implement a written program only if you have covered accounts. It is important to look closely at how the rule defines financial institution and creditor because the terms apply to groups that might not typically use those words to describe themselves. For example, many nonprofit groups and government agencies are creditors under the rule. The determination of whether your business or organization is covered by the Red Flags Rule isn't based on your industry or sector, but rather on whether your activities fall within the relevant definitions.